think money takes up more life space than it should? On this show, we discuss with and share stories from artists, authors, entrepreneurs, and advisors about how they mindfully minimize the time and energy spent thinking about money. Join your host, Jonathan Dio, and learn how to put money in its place and get more out of life.
Hey there, and welcome back to Mindful Money. We're in the late to middle stages of describing the Mindful Money modular financial planning process. Last time we talked about the importance of saving and investing specifically for financial independence, what we used to call retirement. Financial independence is the one goal that's required of all of us. At some point in each of our lives, we're going to be called on to support ourselves without working for an income. If we do not plan on this, then all we will have is Social Security and the kindness of family or strangers. Every financial decision we make shows up in our retirement income. If we drive expensive cars, send the kids to private schools, take big expensive vacations, and live in too much house without considering the savings and investments needed to create the income that rises to match our rising cost of living and then lasts the rest of our lives, then we simply won't have the income we need when we retire. Financial independence requires planning, understanding trade-offs, and then making the trade-offs. And once you have that particular goal dialed in, once you know the amount you need to save and are saving it in your retirement programs, either personal IRAs or your retirement programs at work, then you can start to refine your plan. For our purposes today, that means talking about paying down or paying off low interest debt and or building taxable savings, focused on additional retirement savings, other goals, or just building the nest egg for whatever may come. This episode is the 8th in our 10-part series, which covers everything you need to know to get started creating your modular financial plan. About 40,000 people visit Mount Everest's southern base camp every year. Only 800 make the summit. Getting to base camp at 17,600 feet is a long and difficult trek, and the views at base camp are better than almost any other place in the world. But they're not the summit. So our brief step-by-step guide to personal finance that started 7 weeks ago has brought us comfortably to the financial equivalent of base camp. We have discovered what's worth seeking, developed a vision of a well-lived life, embraced the savings habit, built an emergency fund, eliminated bad, that's high interest debt, and we are saving and investing for retirement. For many people, even these 6 small steps will feel like a stretch. About 36% of Americans earn less than $50,000 annually. If you are in this category, steps 1 and 2 are a painful reminder of things you can't imagine. Be patient with yourself. Remember to keep moving forward, keep working hard, develop new skills, and work on ways to increase your income. We are all in the process of becoming, and you'll get there. According to the Federal Reserve Bank of St. Louis, the median U.S. household income in 2023 was $80,610, and only 18% of individual workers and 34% of families earn over $100,000 in the United States. So for the vast majority of Americans, the simple lessons in the 6 steps we've already covered are going to be enough. Once you've completed 1 through 6, you're going to be on a path to the fulfillment of the vision you created for your life in the 2nd step. It's a simple issue of giving the efforts enough time to bear the fruits that you're seeking. What we've done so far can be good enough. And for most of us, it's all we'll ever need. For the rest of us, myself included, there are a few more steps, refinements really, to accelerate our successes and fulfill our life plans. Some of us are going to attempt the summit. Anyone who gets to base camp is hugely accomplished already, and you should be super happy for being this far along. You're enjoying some amazing views, and you're ready to push towards bigger goals. Now, we want to accelerate these efforts. We want to do more. For us, there are 3 additional steps on the way to the summit. First, becoming debt-free and adding taxable savings. Second, keeping investments simple. And finally, optimizing our portfolios with a few little additional tricks and tools. Today, we want to cover 2 steps in particular. We want to cover the choice between paying down low interest debt and saving in a taxable non-retirement account. Everyone talks about being debt-free, and I agree it's an admirable goal. But as you get better with money, you begin to understand that it's not the most important financial goal, and it certainly shouldn't come first. Once you've paid off the high interest debt, all the buy now, pay later balances are gone, credit cards are paid off monthly, there's no personal loans outstanding, and your retirement savings are on track, Then, and only then, do you begin shedding the low interest debt. Those debts with low to medium single digit interest rates, often collateralized by large purchases like houses or cars. But frankly, even at this point, you may want to wait longer. Once the high interest debt is gone and you're solidly on the path towards financial independence, it's more about building net worth than it is specifically about debt reduction. So there are two remaining ways to build net worth. You continue down the path of paying down that low interest debt, or you can begin to save into a taxable investment account. Now, we're always pushing to increase our income, earn more in the current work, find higher paying work, or take on side gigs. The question I get asked is, what do I do with the excess income now? How about now or now? As you grow your income, you move from step to step along the order of financial operations. Again, that order is emergency fund, high interest debt, retirement savings, and then comes this choice between paying off low interest debt or saving additionally into taxable savings. This is a personal preference. If you're not fully funding your retirement savings programs, then you should focus on maximizing those before turning your attention to these questions. But when you are fully funding your retirement and you have additional excess and want to focus on becoming debt-free, then start with any low-interest consumer debts first, things like furniture, electronics, appliances, and cars, any items with depreciating values, and then start with the high-interest consumer debts and work your way down to the lowest ones. After eliminating consumer debt, move on to the big debts, such as the student loans and the mortgage. In most cases, it's better to leave your house for last. And depending on the rate, you may never want to pay it off. I refinanced my mortgage in 2020 into a 15-year, 1.75% loan. And I plan on making the minimum payment for as long as they'll let me. That means it'll be paid off in the year 2035. Because that's free money. 1.75% is less than the rate of inflation. It's because real estate typically increases in value, and the mortgage will typically be the lowest interest rate you're going to have on anything since its collateral is so strong. So a gradual increase in your home's value can offset much, if not all, of the interest rate you pay on your mortgage. Plus, don't forget your mortgage has some tax breaks associated with it as well. So debt costs you money, so you're generally better off without it, but not investing comes with opportunity costs. In other words, not investing costs you money in terms of the form of potential compound interest. You want to make sure you're getting the most bang for your buck. It often comes down to personal preference, but it might be financially optimal to keep some low interest debt while putting the rest of your excess cash flow to work in a taxable investment account. So you have a choice of paying off a 4% or a 5% loan or investing in a taxable portfolio with a likely long-term return of 7%. The math suggests you'd be better off adding to the portfolio. So you may have heard the story of the wise older gentleman asking children in a high school classroom the following thought-provoking question. Would you rather have a penny a day, doubling every day for 30 days, or receive $1 million right now? The class, quickly splits into two groups. Team Instant Millionaire was enthusiastic about the immediate allure of $1 million. They envisioned all the luxuries they could acquire, homes, cars, vacations. Why wait for pennies when you can have the wealth today? They shouted. Team Penny Doubling was, contemplative, pondering the idea of patience and growth. Let's think this through, one voice called out. What if the penny really multiplies? When Team Penny Doubling does the math, they discover on day one, they get, the 1 cent. But on day two, it doubles to 2 cents. On day three, it's 4 cents. Day four, it's 8 cents. Day five, it's 16 cents. It's pretty slow. But as they continue, everyone watched as the numbers grew. On day 10, penny doublers had $5.12. On day 20, they're sitting on $5,242.88. And then the last 4 days get really interesting. On day 27, Team Instant Millionaire was still, in the lead. The penny doublers had only $671,089, but their doubling still had 3 more days. On day 28, the doubling had surpassed the million received by the other group. The penny doublers had $1.312 million. On day 29, the doubling penny was now $2.684 million. And on the final day, the value of the penny doubling every day for 30 days stood at $5.37 million. The penny doublers had over 5 times the instant millionaires. So the revelation is that while $1 million may seem appealing at first, The true power lies in patience and compounding. The penny represents not just money, but this idea that small, consistent efforts can lead to extraordinary results. The decision to choose the penny was not merely about money. It was about embracing a mindset of patience and understanding the value of gradual growth. Instant rewards are almost always tempting. It feels good to be debt-free, and waiting for something greater, something that boosts your compounding engine, can yield far more than you may imagine. So I will almost always recommend building taxable investments before paying off low interest debt. So investing in a taxable non-retirement account to further build your assets can be just as important and useful as becoming 100% debt-free. Certainly before doing this, make the maximum contributions to your employer-sponsored retirement plans, 401k or 403b, and your individual IRAs. If you're already maxing these tax-sheltered retirement accounts and you have additional savings, then a taxable non-retirement, sometimes people call it a brokerage account, is worth considering. Asset building, another phrase that basically means saving and investing, is arguably the best route to financial freedom. Once you establish a pool of compounding assets, you've immediately increased your chances of getting financially ahead in life. Over time, the magic of compounding grows your asset base at ever-increasing rates. Adding more as soon as possible will accelerate this compounding process. The additional savings can either bring your moment of financial freedom and financial independence closer, or it can bring some of your other stretch goals, financial goals, travel, sabbaticals, or starting your own business into view. Obviously, you don't want to completely ignore debt. But when you do the math, dollar cost averaging into a taxable account often comes out ahead. Even if you can only add $50 or $100 a month into a taxable account, it's worth it, and it adds to long-term compounding. One of the added benefits of building taxable assets is you can always, if you'd like, I'm not sure why you'd want to do this, sell an asset to pay off even the lowest interest debt. In the next episode, we're going to talk about simple, basic, mindful investing. But for now, let's keep a couple things in mind for the taxable portion of your portfolio, because your taxable accounts are taxable. They're not protected from taxes like your retirement accounts, 401ks, 403bs, and IRAs. They are subject to tax consequences with every transaction. You're subject to capital gains taxes when you sell a security for more than you originally paid for it. That's the cost basis. And income taxes when you receive a dividend or interest income. So you want to maintain your taxable investing with low transaction process. This is exactly what we're going to talk about in the next session. And you're going to have to keep in mind that all investing involves risk, including the possible loss of principal. Personally, I would suggest that not investing involves even more risk, i.e. not having the retirement income, not having assets readily available when you need them, etc. So you need to be mindful of how you invest. Again, next week, we're going to talk about how to keep these investments simple and on task. Another really big benefit of having a taxable investment portfolio is the control you have over the source of your spending when you start drawing from your accounts, all of them. When you have a taxable account, along with a traditional IRA and maybe a Roth IRA, all of which are taxed differently, you can choose where to get the bulk of your spending when you retire. This choice gives you wiggle room around taxes. When you take money out of a taxable investment account, any trades to free up cash are taxed at capital gains rates. Since the capital gains rate is lower than your ordinary income tax rate, you can, in effect, choose your tax rates. By keeping your withdrawals from IRAs and other retirement portfolios to a minimum, you keep your income to a minimum. This proves to be an enormous benefit over, say, 30 years of retirement. So depending on circumstances, we often recommend withdrawing no more than the required minimum distribution from your non-taxable accounts. Or if you're charitably inclined, you can give your required minimum distributions directly to charity. This is known as a qualified charitable distribution. By doing so, you might eliminate your income tax in retirement, enabling you to focus solely on capital gains and qualified dividend income, keeping your tax rates nice and low. This is one area of your financial lives where a professional can be, invaluable. So once you move on to paying down low interest debt, or preferably saving in a taxable account, you'll be a little closer to meeting all your big life goals, not just the retirement goals. And in the end, the true benefit of financial planning turns out to not be financial. It's just a life well lived. As always, thanks for listening. Next time, I look forward to describing the easiest possible path to the best possible investing outcomes. I want to share with you a way to invest that doesn't require any time or really any major analysis, that minimizes your taxes and helps you reach all your financial goals. So I hope you're going to tune in next time to learn about simple, basic, mindful investing. Thanks.
Thanks for listening. Full show notes for each episode, which includes a summary, key takeaways, quotes, and any resources mentioned, are available at mindful.money. Be sure to follow and subscribe wherever you listen to your favorite podcasts. And if you're enjoying the content and getting value from these episodes, please leave us a rating and review at ratethispodcast.com/mindfulmoney. We'll be sure to read those out on future episodes.